Well, I think this report shows some of it. It doesn't show all of it, right? We still have to watch, but like, why are these revisions happening? We see it in a lot of data, and it's all moving the correct way. We saw the report yesterday, moving the correct way, all moving in the way, basically, quite frankly, that Warsh probably could have predicted, right? So he comes out hawkish, understanding that data is going to come in soft. That's going to allow him to gain credibility and then kind of push back on the idea of rate hikes in the near term. And that buys him time. And that's his job right now, is to buy as much time if his predilection is towards keeping rates stable, buy as much time by kind of coming out hawkish and letting the data let him retreat. And I think he's actually being quite masterful at this. And other people who have come out and been very aggressive on the hawkish front are now beginning to look like maybe they were jumping the gun a bit.
Okay, but you have I mean, Drew's like over at the Regency.
I know.
Power breakfast. That's not the same. The market economists in the trenches, there's many of them setting up a disinflationary vector. Okay, fine. How vector is it? How steep will that decline be, that path back to the nirvana of 2% inflation?
Well, we're not going to hit the nirvana anytime soon. The question really, in my mind, should be for the Fed, how disruptive is inflation to the economy? The reason we worry about high levels of inflation is because typically if inflation gets out of control, you end up with a rise in unemployment. You end up with reduced economic activity. That being said, that's all dependent on inflation volatility. It's not the rate of inflation, it's the rate of inflation volatility that really matters. If you were to tell me that inflation is going to be 5% from now until 2030, 2040, then I could, as a corporate person, I could plan. Okay, I know what my wage increases need to be. I know what the expense is going to be if I delay a decision. The problem comes in when you have 2% inflation plus or minus 5%, then that creates problems in the planning process and actually reduces economic activity. So you can have higher levels of inflation that are less disruptive than lower levels of inflation if there's less volatility in it.
You say that Warsh played the odds and won. What do you mean by that?
I mean, we all knew gasoline prices were going to plummet, right? We all knew the tariffs had come off. So you could have not, I mean, a lot of people did predict that inflation was going to slow last month for those reasons. And so he made the bet, I'm going to come out hawkish. I'm going to let the data then come in and kind of pull me back from kind of the hawkish side of things. But it's going to appear like the data is pulling me back because I'm data dependent. I don't want to make prejudgments about future activity. And so, he really just allowed the data expectations to be used to his advantage and allow him to move in the direction he wanted, but while also kind of reinforcing his inflation fighting credentials. It was actually a masterful political stroke.
But, it's interesting now. I mean, he has no real influence on what happens in the oil trading pits and the various commodity exchanges because we got WTI crude oil back up at $80 a barrel. And again, there's not much he can do about that, I guess.
But he bought himself July.
Okay.
And now the next time he has to make a decision is September. And we'll see what happens then. And we'll see how he talks about things. His goal is not, like, if the Fed's goal can be solidified to one thing, right, that kind of combines the inflation component and the unemployment component, it's the 10-year yield. Right? If the 10-year yield moves outside of a particular range, it's problematic for the economy. That's too low and too high. Both of them create problems for the Fed. Their job is to keep it in a range, which is really somewhere probably between 375 and 475.
And with his distress over dots and the rest, maybe we'll hear more at Jackson Hole. We're putting that together right now, folks. Drew Matus, is forward guidance just done? And are we just going to get a whole different press conference, a whole different Greenspanian tone?
Forward guidance made the mistake of believing that transparency and clarity were the same thing. They're two very different things. I can tell you, I can be completely transparent, but I could be unclear while doing it, right? So I think, we all joke about how Greenspan talked about things, but what Greenspan was really saying is, I don't really want you to understand exactly what I'm doing, but you'll all have a sense for kind of where my breakpoints are, right? And he had somewhat of an easier job because he was coming off the Volcker, the Volcker Revolution and the death of inflation. So all Greenspan had to do was not mess that up. Warsh actually has a much more complicated job because there was higher levels of inflation that were tolerated. They were actually, a lot of people argued they shouldn't have been tolerated. And now he's walking in, and now people are saying, well, we tolerated it last time, so we can't tolerate it this time.
This is brilliant, folks. This is why we love having Drew Matus in. Okay, so that's fine. You're at the Metropolitan Life Insurance Company, stayed, actuarial assumptions, and all that. How are you advising MetLife on a presumed actuarial assumption on 20, 30, 40, or in Amazon like 50 years? Do you see a dampening of that long-term reach, which is beneficial? Or do you have to set a regime set to a new higher interest rate assumption?
We're heading into a new neutral, longer-term, higher neutral rate environment because productivity is going to accelerate. We are going to see AI improve labor quality. Labor quality is where computers showed up. So you're going to see the labor quality gradually improve over time. But that's going to be a sustained improvement. When you look at the computer revolution, we went from a labor quality contribution to productivity of 0 to plus 50 basis points, and it stayed there for 4 decades. Right? So this is going to be something on the same order of magnitude, I expect, if not larger. It's going to be a job creator, not a job destroyer. And we're going to be wondering what we were also worried about 10 years from now.
So let's just put a bow on the labor market here. It seems about pretty darn good, full employed. If you want a job, you got a job. What's your view of the labor? How do you think the Fed views the labor market?
I think the Fed views the labor market is in pretty good shape, but I think that they maybe see a little bit more downside risk. There was a good article today about kind of long-term unemployed. That's a problem. Yep. You want to get people in. I do think one of the things that AI is doing is encouraging people to try to hold off hiring in certain places. That's going to prove to be a mistake, right? Because when the economy accelerates, or once we go through a downturn, people are going to remember kind of who were out there kind of, trying to save the money on kind of the junior employees. And if you don't invest in junior employees, you're not going to have senior employees that are worth anything in a few years.